Hey everyone, if you're following my channel, you would know that I focus on two key parameters while investing in the company: fundamentals and valuation. For a stock to create massive return, it should be fundamentally strong and available at fair valuation. Now, fundamentals can be checked by looking at company's business model, key moat, that is competitive advantage, leadership, future growth prospect, and financials that include your understanding of company's P&L, balance sheet, and cash flow statement. But the trickiest part of investment is valuation assessment. Let me be very honest, it's not easy to identify the true value of a company. And in today's video, I want to focus on this valuation part. Now, within valuation, one of the most common assessment metric is PE ratio, that is price to earning ratio. For instance, a PE of 20 basically means you are willing to pay 20 rupee for every 1 rupee earning. Theoretically speaking, a PE below 20 to 30 is considered cheap, whereas PE above 30 to 40 is considered expensive. However, practically, this is not the right way to analyze the valuation of a company. In fact, a stock trading at a PE of 50-60 could still be very attractive, and a stock trading at, say, PE of 10 may still not be attractive. So in this video, I will try to answer how to really gauge the valuation of a company and what is the right PE you should pay while investing in a company. Here I would explain the concept of operating leverage and deleverage with real-world example that plays a crucial role in PE ratio assessment. I'm sure this would be very helpful for you all. Alright, let's get started. So first and foremost, there are two key parameters that decide how much return a stock can generate. First is EPS, that is earning per share, and second is valuation. Now let's say there's a company ABC with earning per share of 50 rupee and current market price of 750. So its P ratio would be 750 by 150, that is 15. Now let's say company's earning per share has increased from 50 rupee to 100. It means earnings have doubled. Now ideally the stock price should also reflect that and stock should double. But here valuation plays a key role. Let's say market value the company at same PE of 15. In that case, its share price would become 15 into 100, that is 1500. Very simple. But what if market decide to value the company at PE of 30? In that case, valuation has expanded 2 times and earnings have also expanded 2 times. So now the share price would become 30 into 100, that is 3000. So here the stock has generated 4 times return. Now let's assume company is already trading at PE of 40 with EPS of 50 rupee per share. So current market price would be 2000. Now if EPS grows from 50 to 100 but market decide to value the company at PE of 30, then company share price would be 3000. Can you see the difference? In spite of 100% growth in earning, share price has only grown 50% because valuation were already at higher side of 40 and market decided to give a PE of 30. So at the end of the day, earning growth is very important, but at the same time, valuations are equally important. If you invest in a company with higher earning growth, but valuations are also high, the return potential might be limited as there are chance of valuation derating if the earning growth is not sustained. The best scenario is to identify companies where earning growth is good and PE ratio is also low. That gives a good scope for valuation re-rating. So when earning grows and PE also expand, share price grows more. But the question is, what PE is considered as low PE and what PE is considered as high? That's a $1 million question. It actually varies from company to company depending upon earning growth potential. Let me share a few case studies to explain this concept. Okay, let's first start by comparing the 3 IT companies from Tata Group and look at their PE ratio. So first is Tata Consultancy Service, that is TCS. Second is Tata Elxsi and third is Tata Technology. Now if you look at the PE ratio of Tata Consultancy, it is at 29.6. And if you look at Tata Elxsi, it is at 56. And your Tata Technology is at 59. Now how do you decide which stock is expensive and which stock is cheap? First of all, if you just look at the comparison in terms of absolute number, obviously in first look, Tata Consultancy looks cheapest with a PE of just 29.6. But that's not the right way to look at it. For that, you need to understand the earning growth. And if you look at the earning growth of TCS, in 10 years, its earnings have compounded at 9%. In 5 years, it's compounded at 8%. And in 3 years, it has compounded at 12%. So on an average, Tata Consultancy Service earnings are compounding at an average of 10 to 11%. Now considering that kind of earning growth, it makes sense not to pay a PE of about 25-30. Why? Because obviously the earning growth is not that high. And even you can look at the PE ratio of historical data in last 3 years and 5 years, And one of the way to understand whether it is a reasonable valuation or not is to look at the median P. So if you look at 5-year median of TCS, it is at 30.2. At one point in time, it touched peak of 40, and then the P ratio corrected, share price also corrected. And today the P is in the range of 29, which is similar to its 5-year median P of 30. Likewise, its 3-year median is 31. So just by looking at median PE, you can say that TCS valuations are reasonable because it is trading near its 3 to 5-year median PE, right? So I hope it makes sense. As far as Tata Elxsi is concerned, its PE is 56. Now whether it is cheap or expensive, for that you need to look at the earning growth. So in 10 years, your Tata Elxsi earnings have compounded at 27%. In 5-year, 22%, and 3-year, it has compounded at 29%. Obviously, when the company is growing at 25 to 30% compounding, it will command a premium. Now, what is the reason? TCS is more into your traditional IT business. It's already a huge giant with market cap of 13 lakh crore. Tata Elxsi is more into your IT industry in your EV space. Right, so it is into EV software and it's a mid-cap company with a market cap of 44,000 crore, and because of this new age business, it is growing at a much faster rate. And you can also see, look at the kind of growth in earnings. So obviously when the company is growing at a faster rate, it will command a premium. Now the question is whether is it worth paying a PE of 56 or not? One of the ways you can look at the historical PE in 5-year. So if you look at it, interestingly, company's PE ratio was at levels of 16, 17, crazy cheap valuation before COVID. And then we saw crazy rally, right, where the PE ratio zoomed to levels of 110. During this phase, company's share price zoomed more than 10 times. So it was at levels of around 600 during COVID, and then from there it touched levels of 10,000. Right, so when the share price zoomed, from cheap it became reasonably valued, and then it became super expensive, where the P ratio touched peak of 110. From there it corrected, right? So the correction happened. Now what the reason why the P ratio has zoomed so much? Because companies' earnings were expanding at very fast rate. So if you look at this particular phase, during this time, companies' earnings were growing at a very fast rate. So market was comfortable paying a very high premium. Also, this was because of high liquidity. There was a lot of money flowing in. It was a bull run and people wanted to buy Tata Elxsi at any price. Because of that, the valuation skyrocketed. But there has to be a price that you pay. You cannot pay any PE ratio to a high growth company as well. That's where when the growth started slowing down. If you look at it from those kind of growth, in fact in last 1 year the earnings have not grown much because of slowdown in US, and that's when market realized that no, it is too expensive, and then market started there is profit booking that happened, and because of that it's been nearly 3 years since the share price is corrected and consolidated. Look at this, in 3 years since those August 22 high, in fact 2 years actually, the share price has actually corrected 30% in last 2 years because the valuation were very expensive. Today, are the valuations reasonable? So the P ratio suggests that in 5 years, it is trading at a median P of 58.9, and that is its current P is 56. So similar to its median P. Still, I believe that everything would boil down to the earning growth in the coming quarters. If your Tata Elxsi can sustain your 25-30% kind of CAGR growth in the years to come, it is worth paying this kind of PE. Maybe around 50 is a decent PE, because understand, it's a part of Tata Group. It's into your new age business of EV software and one of the leading player. So it will command a premium. The only question is, what is the right P you are comfortable paying? So for me, I believe that it is decent at 56, maybe 45, 50, it would be very good valuation where you can even consider adding it. So this is how you got to look at it. Likewise, if you look at Tata Technology, its share price, its IPO happened at 500 rupee, then it zoomed to levels of 1400. Obviously, the valuations were crazy high. If you look at it, P ratio was at levels of 85. And then it became super expensive. Then what happened? Share price kept on falling. Today it is at 992. What is the PE today? It is at 59. Right? So again the same story. It's a part of your new age EV software business, a mid-cap company, and leader in the segment, part of Tata Group, obviously it will command a premium. What is the right valuation? Again, it's a question mark. So today if you ask me, at a PE of 59, it is slightly expensive. Earlier it was very expensive. Now it looks like slightly expensive. Again, if you look at the earning growth, in 3-year earnings have compounded at 42%. Although trailing 12-month earning is just 9% because of slowdown. So if Tata Technology can compound its earning at, let's say, again similar to Tata Elxsi at 25, 30, 35%, it is justified paying a PE of around 45, 50. So that is how I do my assessment of looking at the valuation. It is slightly on the higher side, maybe another 10, 15, 20% correction, it would look reasonably well. Right? So this is how you can look at it. Another very good example is Happiest Mind. I mean, it's a fantastic case study of the rise and fall. If you look at the share price, company launched its IPO in bull run at around 160 rupee. From there, it has seen an exponential growth where shares zoomed nearly 10 times. What happened during that time? P ratio zoomed from levels of 20 to levels of 145, became super expensive, and then share price has been correcting and consolidating, from highs of 1500. It's been nearly 3 years since the share price has corrected and not even touched its peak of 1500. Today it is trading at 900 rupee. How is the P ratio? So P ratio has fallen from 145 to currently at 56. Its median P is also 57. So now trading near its median P. Still again the question is it worth paying a P of 57.9? So if you look at the growth, in 5 years, its earnings have compounded at 55%. Although there is a slowdown recently where trailing 12-month earnings are pretty flat. But I was going through company's con call where management has mentioned that they are expecting a growth of 35 to 40% for FY25. So again, this is not a guidance, but this is an estimate, and they're expecting margin in the range of 22 to 24%. And their recent margin, if you look at the current margin, it is around 21%. So based on that, if company can grow at 35 to 40% in FY25, I believe that the bottom has been made for Happiest Mind. Valuations are still on a higher side. I would be comfortable paying a PE of 40, 45. But if company grows at your 35, 40% as guided by management, its P ratio would fall if the share price does not zoom exponentially. So this is how you can look at it. In fact, now I was going through recent share price movement, and on Friday I have seen a huge volume buying in the company. So from those lows, it has share price has slightly jumped, and I think that bottom has been made. From here I don't see a lot of correction in Happiest Mind. Like I said, slightly expensive, but again, it is now not crazy expensive. So you got to look at the earning growth and decide what is the P you got to pay. First of all, please be very clear. You cannot compare TCS with Happiest Mind or with your Tata Elxsi or Technology. Every company has its own earning trajectory, and based on that, you need to decide. Like I said, you can also look at the median P to have an idea in terms of what is the, whether it is fairly valued. So if company is trading at near its median, you can say it is fairly valued. Again, it's not a short method, but it's a decent way to look. So if the P is below its median PE, you can say it is slightly undervalued. If it is P is above its median PE of last 3 to 5 years, you can say it is overvalued. Having said this, you have to look at the earning growth prospect, and if you can get that idea, whether the company is growing at, let's say 20%, 25, 30, 35, based on that, you need to decide what is the right PE. Likewise, I've got another example of CE Infosystem. This is again one company that I'm been talking about from day one, and share price has in 1 year it has doubled. And if you look at the P ratio, its P is 102. Is it cheap? Is it expensive? For me, so again, let's have a look at the earning growth. So earning growth is 40% in last 3 years. Company is growing at an exponential rate. And what is the expectation? So expectation is that company want to cross the milestone of 1000 crore revenue by FY 27-28. What does it mean? So currently company has got sales of 379 crore. So if company achieve the management guidance of 1000 crore by FY 27-28, it would compound at 30 to 40% CAGR at top line. And bottom line also, obviously if it maintains its margins, bottom line would also be in the range of 40 to 50, around 40%. So if that happens, I believe that it should command a PE of maybe around 70, 75. Today at PE of 102, I believe it is on higher side. Likewise, there are other growth companies like Dixon that is growing at a very fast rate. Look at this, 42% earning growth in 5 years, 43% in the trailing 12 month and 32% in 3 years. Again, extremely high growth company. Electronic industry is in nascent stage. Dixon is a leading player in India in electronic space, sort of mid cap. Again, it's become a kind of large cap now at 69,000 crore. But the point is, it is on high growth trajectory. The question is it worth paying a PE of 188? In my opinion, it is too expensive. So any company, no matter whether it is growing at 30, 40, 50%, if it is at a PE of more than 100, I believe that it is very expensive to me. So unless companies earning doubles every year, right? So if that is the case, it's a different story altogether. But for a company at 69,000 market cap that is growing at around 40% CAGR, I think PE of 100 or maybe around 70, 80, 90 would be justified. In fact, if you look at the median PE is 110. So currently it is trading way above its median PE, and that for me is very expensive. Likewise, same story with Keynes, a PE of 136. Although growth is exponential, look at this, 166% growth in 3 years, 93%. So Keynes is growing at a much faster rate than Dixon. So maybe it should command a slightly higher valuation of 80, 90 or maybe 100, but 136 is too much. So based on the earning growth CAGR, you have to decide what is the right PE you should pay. And like I said, you can always look at the historical PE on screener and look at the median PE and compare how is the valuation as compared to median. Right, so these are high growth companies. You can't expect Dixon or Keynes to trade at a PE of 25, 30, right, or MapMyIndia to trade at PE of 25, 30 because they are growing at a very fast rate. But is it worth paying a PE of 100, 150, 200? That is a big question. That for me is very expensive. So this is how you got to understand and do the analysis. Now, one very important aspect while doing this PE ratio assessment is to look at the operating leverage and deleverage. And one of the great example is Maruti Suzuki. Let me just share you the PE ratio of Maruti and then decide what happened. So just imagine it's 11 February 2022 and Maruti is trading at a PE of 81. Now tell me, would you be comfortable paying a PE of 81 to Maruti? So now just look at it, what happened. So date is 11 February 2022. Look at what happened. 11 February 2022 is somewhere here. So on 11 February, Maruti was at 8,700. From there, today it is at 12,800, 12,200. And what happened to PE ratio? It has now fallen to 28. Now just imagine your share price has zoomed 50%, but PE ratio has fallen significantly from 81 to 28. How did that happen? Because of operating leverage. Let me share you this information. Look at this. What happened? Basically, Maruti operating margin during 22 was 7%. From there, it has expanded to 13%. Because of that, its earnings have grown from, your earning profit has grown from 5,700 crore to 18,000 crore. And your net profit has zoomed from 3,800 crore to 13,000 crore. So here operating leverage has kicked in, where because of increase in sales, companies, obviously the fixed cost is always there, but because of increase in top line, companies' operating margins have expanded. That is first reason, and second reason is the raw material prices have fallen. Because of that, its fixed cost has also reduced and overall cost has also reduced. Because of that, its margins have expanded. In fact, it used to command these kind of margins earlier also, but then during COVID, the margin fell down significantly. Because of that, its earnings tanked and its PE ratio expanded, right? So you can't just look at PE ratio and say it is expensive. At PE of 81, Maruti was still cheap because it has jumped more than 50% and PE ratio has now fallen to 28. So you got to understand how is the margin going to be, and that's why in every analyst call, they ask what is the margin guidance for the coming quarters and years. And that gives you a fair idea that what is the earnings you can expect. Likewise, you have got example of Tata Motor. So at one point in time, Tata Motor was in loss and there was no PE ratio for the company. But then there was, when it came into profit, its PE ratio was 111 on June 23. Now just imagine at 111 PE, would you be invested in the company? Just look at what happened. June 23, on June 23, it was at levels of somewhere around 560, and from there it has already nearly doubled. Whereas what happened to PE ratio? It has fallen from 111 to now at 9.9. In fact, if you look at 1 year, 1 year ago PE ratio was 19 and price was just 567, right? And in 1 year, price has nearly doubled and PE ratio in 1 year has fallen from 19 to levels of 10. How did that happen? Because its earnings have expanded, its operating leverage has kicked in from 9% to 14%, and because of that, net profit has zoomed from your minus 11 crore to 2006 and from there to 31,000 crore, right? So it's very important to understand how is the guidance of the margin. Likewise, there is an example of operating deleverage where you have got Laurus Lab. Very interesting case study. What happened with Laurus Lab is company's margins expanded during COVID from levels of 16% all the way to 32%. Because of that, its profit zoomed from 94 crore to 984 crore. And because of that, what happened? Its share price expanded from 68, 80 rupee all the way to 700. So nearly 10 times growth. But then what happened later? Company's margins contracted. So operating deleverage kicked in, and from 32%, now the operating leverage is at just 50. So, if you look at the operating profit, it's just 15%. Because of that, company's net profits have fallen from 984 crore to 162 crore. And due to that, if you look at it, in spite of no return, in fact, it was at 350, today it's at 430. So not much movement in the share price, but PE ratio today is at 143. Obviously, when you look at PE ratio of 143, it looks super expensive. But once your company would come into, the operating leverage would start kicking in. In fact, management has already guided for 20% kind of growth in FY25. So once this operating leverage would kick in and margins would expand, its PE, your earnings would increase big time. And once the earnings would increase, PE ratio would fall. So you can't just look at PE ratio and decide whether it is cheap or not. A great example of operating deleverage. I've got another example of Polyplex. So what happened? Same story with Polyplex also. It was, just look at this, during COVID, so company's margins expanded big time from 11, 14% to 25%. Because of that, company's net profit zoomed exponentially all the way from 16 crore, 300 crore to 682 crore, then 965. But then what happened? From 20%, from 25%, margin fell down to lows of 6%. And because of that, its earnings have fallen from 860 crore to 86 crore. And due to that, what happened? Share prices also tanked. And if you look at it today, it is showing a P of 82.6, which is looking very expensive. But if you look at it, it's because it is trading at near all-time low margins. Once the margins come back to normalcy, say at around 10-15%, its earnings would again expand and then its P ratio would fall. So the point is that you can't just blindly look at P ratio and say it is expensive or cheap. You got to understand how is the margins of the company, what is the expectation in terms of whether the margins are going to increase or decrease. That kind of understanding would happen once you understand the cycle. So Polyplex is a great example of a highly cyclical industry where the margins have expanded in the past and then contracted from 3% to all the way to 25 and again then to 6%. Now I expect that the worst is over for Polyplex, and from here the margin should expand, and once that would happen, your earnings would increase and then you will see the P ratio falling. Then another great example in my opinion is your chemical industry that has seen operating leverage and then deleverage. Let's take example of Deepak Nitrite. So in case of Deepak Nitrite, what happened is margins expanded from 12% all the way to 29% because there was huge demand, and the profit zoomed from 79 crore to 776 crore. And then what happened? Your margins fell down from highs of 29 to 15%, and because of that, the net profit fell down from, there's not much fall because the earnings have grown, but the growth has got stagnant, right, at 776 to 800 crore. The question is it the bottom? So that is a big question. If once you get this answer, whether the bottom has been made or whether the company would grow at these kind of margins, once you get this understanding, you will be able to figure out whether it is worth paying a P of 46 or not. So historically, if you look at it, company's median P is 28. From there, today it is at 46. But if company's margins expand from 15% to say 20-22%, earnings would expand big time, and then you will see your P ratio falling. Right, so I hope you got a good sense of operating leverage and deleverage. Here, a very important aspect is to look at the cycle as well. Hotel industry, for that matter, let me take Indian hotel, has seen a great upcycle recently. So if you look at it, there was a point when it used to command 15-16% margin. Then because of COVID, what happened? The margins fell down badly. In fact, companies was in loss at 362 crore of operating profit, minus 362. From there, what happened? Margins expanded all the way to 32%. And look at the kind of growth in operating profit from 362 crore minus to 400, 1800 and all the way to 2160, and from loss of 796 crore, company is currently at profit of 1330 crore, right? So again, if you look at P ratio in 3 years ago, so if you take it, during November 22, it was at P of 235. Would you have the courage to invest at a P of 235? Just look at what happened. October 22, it was trading at levels of October 20, it was at 313. From there, today it is at 600. So your share price has doubled, but P ratio has fallen from peak of 200 all the way to 70. Right? So basically the point is, you got to look at the cycles. You got to understand whether the company is in operating leverage stage or operating deleverage state, right? How is the margin going to expand? And based on that, you got to decide what is the right P you want to pay. So it's not that easy. Like I said, you have to have a good understanding of the cycle. You have to have a good idea of what is the growth expected in the coming quarters. And for that, you can always refer to the transcripts where the management interact with the analyst and they give a guidance. By the way, you can also refer to my website where I've got this series on weekly video where I share one exclusive video every week with my audience. Basically, this is for long-term investment, where the idea is that a lot of you would be having a job or business and would not get a time to do the research, and that's where I try to add value, where I spend nearly 8-10 hours a day and try to analyze market. And in fact, I also share my own investment strategy, my own conviction, what stocks I am buying. That gives you a good idea in terms of how is the valuation, and of course, I share my own thought process why I'm buying it. Right, so this is the series, and if you want to explore it, I'll share the link in the pinned comment, and you can also explore it via the join button on my YouTube channel. So yeah, this is it for this video. I hope you got a fair idea of valuation assessment, how you got to look at the P ratio. You can't just look at absolute number and say whether it is expensive or cheap. Then you can't, one of the ways you can look at the median P. Then again, most important aspect is earning growth. You got to understand how is the earning growth, and based on that decide what is the right P it should command. And then I've shown you the example of operating leverage and deleverage. One last example I want to share is Tata Trent. And it has been a crazy journey. In fact, I discussed Tata Trent on my YouTube channel nearly 1.5 years ago. And let me share the PE ratio of the company. So I remember covering it around in month of March, April, when it was trading at levels of around 145 PE. And I remember a lot of people commented that it is super expensive. Now just look at what has happened to the share price. So since your March, April month, it was at levels of 1300. From there, today it is at 5,200. So 4 times growth in share price, whereas PE ratio from 145 it has expanded to now at 200. So 50% expansion in PE ratio, but share price have grown 4 times. Because companies' earnings have expanded huge big time from 35%, from 35 crore to 394 crore, and now all the way to 1477 crore. And the margins have expanded from 4% to 13%, and now it's 16%. So while doing my analysis at this level in 2020, in March 23, I knew that company is going to explode big time. And that is the reason I even told you that it is looking very attractive at current level. Although today, I think the share price has rallied quite a lot and it's become expensive. Likewise, I did an analysis of Netweb Technology a few months ago, and from there, the stock has already more than doubled. So just go back and check my analysis on Netweb. And at that point in time also, 1 year ago, the valuations were very high at P of around 96, and from it's not showing the right picture. But yeah, the point is that P was very high at around 100, I guess. From there, the valuations have again grown, but the thesis was simple that it is a high growth company. Look at the kind of earning growth. In 3 years, the profits have grown at 110% CAGR from 4 to 8, 22, 47, 76. So it's a high growth company. Because of that, the valuations have grown and obviously it would command a premium. Again, the question is it worth paying a P of 190? For me, today it is very expensive, but based on the assessment that I did that time, it was looking decent, and that's why I discussed it on my YouTube channel. So don't just blindly look at PE ratio. Try to analyze all these factors before you decide whether the company is cheap or not. I hope you'll find this video useful. I'll see you next video. Till then, take care.